Okay, welcome in everybody. Glad to see a good number of faces and a lot of new faces this time around, a couple familiar faces as well. My name's Nash. We'll get into more formal introductions in just a minute, but before we do that, let me go over a couple housekeeping items. First, you'll see a camera over in the corner, but we're not going to be capturing anybody. Your voice isn't going to be in it, so no disclosures or anything necessarily there. I just wanted to let you know. But we're going to be hopefully filming this and putting it on our website so that if you miss a day or you have somebody who wants to get some of the information, you can pass that along to them. And you can always request the videos if you miss a day as well. You can reach out to us via email. We'll get to that contact information in a moment. Bill's going to pass around a sign-in sheet. Just find your name, initial next to it, and mark where you heard about us. And if you don't see your name, feel free to fill it in at the bottom or anywhere there's room. But I'd like to get a feel, get an idea of where you heard about us, how you heard about the class, so that we can attack those advertising revenues. Let's see. Firstly, our first thing that we're going to look at, this is going to be up every class, but this is our disclosure that just goes over some of our legal obligations. So let me go ahead and read that for you. This seminar is being presented for educational purposes and is not intended to take the place of specific financial advice. What's right for one individual will not be appropriate for everyone. You are encouraged to seek professional advice in the areas of investing in retirement plans, insurance, taxes, banking, real estate, and estate planning as appropriate to evaluate your unique situation. Many of the statements given throughout the class are our opinion and should not be construed as a specific recommendation of any security or investment strategy. So everything we talk about, broad strokes, conceptual, it'll get you to where you want to go, but nothing we're saying specifically is what you should do exactly. Your situation is different. Everybody's unique, so make sure that whatever solution you come up with or you get recommended to you is catered to your individual situation. Any references to previous client experiences are not representative of all client experiences. It's that common saying, past performance is not indicative of future results. While we can use it to get a general idea of where we're going, you can't rely on previous data to give you a guarantee. There are no guarantees in this game. That's just how it goes. When reviewing the historical performance of various investments, keep in mind, like I just said, past results are no indication or guarantee of future performance. Keep that in mind. It's all data. We're working with probabilities, not guarantees. Everything is general ideas, averages. We're not claiming to pick the next winner stock for you. Always read a current prospectus before investing, and really what that boils down to is, yes, read the prospectus, but make sure you understand what you're investing in and how it works and what it's doing, or make sure that you trust the person who's recommending it to you and understand why they have chosen to recommend it to you. Due to time constraints and varying degrees of student knowledge, some topics discussed may be covered in simplified terms. So we encourage you to refer to the book, Active Retirement Investing, The Process, which is pretty much, it's how we run our book of business. It's how we do our job. So if you ever want to get a better idea of the things we're talking about, this book will have it in there. And you'll find more detailed information and a discussion of potential risks associated with specific investment products in there. Welcome our students of the seminar who seek our opinion and services outside of the classroom if you choose, but we will not be soliciting any business during these classes. So if you want to have a conversation, that's fine. You can come to us outside of class hours, but we can't give any recommendations and we won't solicit any business during the length of the seminar. Contact these regulatory agencies for more information about the role and responsibilities of broker-dealers, registered investment advisors, and their representatives. You'll see two organizations here. The first is the Financial Industry Regulatory Authority. That will be one of the regulatory authorities that breathes down our necks for your safety. And you will see their website that you can check on registered representatives and registered investment advisors, which is brokercheck.finra.org. If you're going to engage a professional, or if you already have, head over to this website and plug their name in. You might be surprised by what you find. You also have the Securities and Exchange Commission, which I'm sure everybody's heard about that all the time when they talk about stocks in the financial markets, but they're one of the big regulators of us as well. So by remaining in class, you acknowledge that you've read this disclosure and understand the content, and you can request clarification of any part of this document at any time by either speaking to one of us individually or by calling our office at 916-863-1266. So next. A couple other things we got to go over. In case of emergency, we've got a couple different phone numbers that we can reach. Obviously, you have the police services for 911, and if we dial that on the campus phone, it'll get us there nice and quick. If you need to call on a cell phone, it's this number here. Non-emergency number, police administration, and then your transportation and parking services as well. And just in case we need a little freshen up, we're going to watch a little 30-second video on how to perform CPR in the event that we need to. So let me just pull that up really quick. And okay. Let's play this.
Your hands can
correct.
save a life. It's 3 easy steps. Step 1, check. Tap the victim's shoulder. If you don't see any breathing or movement, it is serious. Step 2, call 911 immediately. Step 3, compress. Interlock your fingers. Use the heel of your palm to push down in the center of the chest. Know what to do. Check, call, compress. Save a life.
Okay. Now let's move on to the rest. Oh, okay. All right. Let's relax. Okay. We've got a couple other numbers just in case you need to call any of these. I'll just leave them up for a second and we'll move on. So before we get into our introductions, I just want to kind of go over the different things that you'll see on your desk. Firstly, you'll get the book, like I mentioned. You can kind of think of this as your textbook. You don't need to follow along if you don't want to, but it has a lot of explanations of what we talk about and just goes more into depth of all these different pages. You'll always find something you didn't know before. It'll come with a little bookmark so you can save your progress. You'll also get a little notebook just in case you want to take any notes, which I highly recommend that you do, especially if you have any questions that come up that you want to ask later, because we'll stick around at the end of classes to answer any questions, or if you need to, you can call us, email us, get in contact anytime. You'll also have our schedule for our class, which will show you all the different topics that we'll be covering through our 12 weeks, as well as the holiday on March 22nd for spring break. So make sure you don't come when there's not a class. You'll also get a little readiness checklist that we have. It's just something to look at when you're looking at your financial circumstances. It's a good way to kind of check off a bunch of things that you should have done. So whether you've done them or you haven't, it's a nice reminder of the different things you're going to need to do. A lot of these things we'll talk about in the class, obviously. And then the last thing is this active retirement investing test. It's something we have at the back of the book just to kind of check your knowledge on all the things that you've learned. So maybe at the end of class it might be worth doing, or maybe when you finish the book it might be worth doing. But just a couple things to test your knowledge and see where you're at. Okay, let's see. So if you miss any classes, there's no worries. There's no attendance requirement for us here. But if you want to know about what we talked about, obviously you can look at the schedule to look at the concepts, and then you can dive into the book if you missed that day. YouTube is always a great resource for a lot of these things. Or you can reach out to us and we can provide the recorded video of that day in case you want the content to go over for yourself. Or you can call us and ask questions and we'll be happy to answer. I don't know how many of you know this, but we also allow students from Sac State to take the class for free. So if you know any college students that are just super ready to learn about financial planning for retirement, I know there's so many of those, please recommend them. And if you have any friends or colleagues that want to try the class out, or any other class from Renaissance Society, they can go to a class once completely free of charge. So be sure to use that, whether you want to bring them here or you want to bring them somewhere else. If you have any questions, feel free to raise your hand whenever during the class. We'll always be ready to pause and answer your questions because we want to make sure that you understand. A lot of this information can get really convoluted and complex, seemingly for no reason at times. So please, if there's something you don't understand or you just want to review again or you want to know about a more specific circumstance, feel free to ask a question at any time. Always happy to answer. It's always better that we don't make it to the end of class because we've been clarifying things all day than to make it to the end and feel like you didn't learn enough. So don't be shy. Always ask questions. Up here we have extras of everything that you've got on your desk: books, notebooks, pens, all the different worksheets, and these little buttermints that I just find absolutely delectable. We've got a couple handouts as well, just crime prevention guides and identity theft, things that you just need to be aware of in this stage of your life, especially when it comes to your finances, because you access a lot of things online with your computers and with your phones, through emails, so there's a couple different things that you might want to be aware of when it comes to your security, so just keep that in mind. And if you're going to take extra books or anything for friends, please, I would hope that you do that next class so that we can bring a lot of extras, just so that if anybody else new shows up, they can get their first copy. As I mentioned before, or as I actually have not mentioned yet, but I'll mention now, this class is taught primarily by me, but also by my co-host, Bill Bailey, who will go ahead and introduce who we are, what we do, and why we think we're qualified to teach. So go ahead, come up.
And could you confirm my recording on that?
Oh, yes, of course.
I've been teaching this class for, about 9 years, twice a year, so it's evolved, and it's kind of fun. This time, the outline and the material's getting a little bit more advanced, and we're getting more to it. So if you have any questions throughout the class, like Nash mentioned, raise your hand. Some people come into here, they might be intimidated, thinking, oh, this is too advanced for me. I would recommend hanging in there and just listening and see what's there. It's kind of like you're on a cruise ship and they make you sit outside the room and put on the guard in case the ship goes down. You want to be prepared. If you learn more about the process, if your family member helps you or you have a professional helping you, you at least have some idea of what they should and shouldn't be doing. If you decide to take it on yourself, the book is written for you. All you have to do is read it 3 times, click your heels, you can do the whole process. But it's very important that you learn the whole process of planning to do the investments, because what value are the investments, no matter how well you've done, if you lose them to a lawsuit or improper registration or something was wrong, or taxes when you didn't need to pay them. So you're going to be able to see the inside scoop on how you should be managing the money and doing your financial planning, or your partner or your well-meaning family members. You'll get some good advice from us, or if you did use a professional, as Nash indicated, there's places you can check on the background. Because we've had some amazing little stories where we checked on, let's say, another advisor and what their background was. I'm seeing a yes? A no? Okay. So, and if you have stories without telling us anybody's name, that's kind of interesting. But the government's very good at regulating us, and everything in our background, you can look up either Nash or myself, find out every tests that we've taken, license that we have, and any firm that we worked with, and if in fact, hopefully, there aren't any complaints or violations. But we've seen other advisors with some pretty serious stuff there. So you can look around and see what's out in the market. So please sign in the sheet. We'll pass it around. It'll give us some idea of how you learned about us, so we can put that out again. So the sign-in sheet asks where you learned about us. The class, as Nash mentioned, it's from 1 o'clock to 2:30, but he'll stick around from 2:30 to 3 and answer questions and interact with you on information that you might want to have. And if we can get online, maybe bring up Morningstar at some point in the class, we can look up funds for you and tell you this fund looks pretty good. Now the class is 80–90% about investing, but it's a real good idea that we touch on the financial planning parts for the reasons that I mentioned. We don't want you to make a serious mistake, sell a fund that you've had for years and there's a lot of gain, and if it's not in a retirement plan, you could really regret that. So there's plans of doing that. We found that other businesses that they might go to manage the money don't consider what your current tax situation is. So we want to be careful of that. It's a fluid attendance. I'm here from 1 to 2 o'clock. I'm leaving early. My dentist is very important. And it's across town, so I don't want to be late. But so the times are very fluid. If you can't make it, let us know, but it's not a problem. Just come back after your trip or going to the doctor or doing something else that you might need. He mentioned you can bring a friend. That's great. Students, we'd like, if you have any family members that are thinking about the financial planning industry as a career, have them come in and check this out, because we think it's a very good option for people. But it's just for the young people, they tend to want to go with the big companies and things like that. There's 12 classes. Nash will talk about the 3 phases of the investment and the planning throughout those classes. The concepts will be repeated occasionally. This is a foreign language for some of us. If you're brand new and you just want to learn enough to keep yourself out of trouble and protect yourself, great. If you're an advanced level investor, Nash will probably come up with some good ideas for you, but there'll be times where you'll see the same concept a few different times. We want to be able to let you catch up on that, kind of like a foreign language class. The other thing that I push as the old guy in the room is, please, everything that you learn here, pass that on, whether it's to your grandkids if they're just starting to work, or your adult children, or it's older people down the street in an old house. If we touch a topic that doesn't apply to you, it might apply to your adult children who are just going to work and signing up for a job. So we want you to be our junior financial advisors to everybody else. And of course, the topic on the book is active retirement investing, but it's whether you do your own investing. That would be fantastic, but some people don't have the time or the interest, so those people then want to check on whoever's advising them and or a professional, so you can see what the industry is all about, and then maybe help you make some other decisions at that point. Phones, we'll put them on silent. I just remember to do that for myself. So that's about it. If I'll be raising my hand occasionally if I have a question, because Nash is more credentialed than myself, although I have 44 years of experience. With Nash's background, he's certified as a fund specialist, meaning mutual funds, exchange traded funds. He's certified in income planning for retirement. He's certified as a tax specialist, not a tax preparer, but has some idea, because we need to know any move that you do, is it going to affect your taxes. Certified in estates and trusts. He has a basic background, like most advisors, in wills, living trust, durable power of attorney, and a variety of other types of trusts. And a certified annuity specialist. We're not real keen on liking annuities. If you already have them, that's fine. The main annuity that we like, although it's got severe problems, is Social Security. Beyond that, you can create your own annuity with treasury bills and things like that. He'll cover. He's also a chartered financial consultant. That was, what, a 2-year program or so?
Something like that.
Yeah, quite a long time that he's been studying for that. And he'll continue to upgrade his credentials as time goes by. So I've been in this business 44 years, graduated from Sac State here. Used to dive off the bridge. I was a gymnast. So double front with a hat to still proud of it. Anyway,
Oh, well, if you want to introduce yourself as well.
I've got some of the lower level certifications that Nash has. I didn't get a master's degree until I was like 60 years old. Used to be dyslexic, and it was very frustrating to have to study, and like everybody else, couldn't afford to come back to college for that master's degree. But now the businesses allow us to do things either online and prove that you know what you're doing at that point. We've both written this most recent book, Active Retirement Investing, a couple years ago, and then we'll be upgrading it in a year or so. So that's about it for me. I'm going to stick around in the business for the next 10 or 15 years. Nash and I are in the same office. We have several employees. There's 11,000 affiliates throughout the country with the home office that we work with. We're an independent investment advisory associates practice here. So we believe in fee-based asset management. If you have an advisor, we don't really like the commissions and all that kind of stuff. But if you have the interest and the time, you can do it yourself. It's just a matter of how much time you have and how much interest. That's it for me.
Thank you. So, like you mentioned, we run our independent financial advisory firm under the name Wealth Strategies. You can find some of our contact information here, just in case if you want to reach out to us for any information, clarification, or you just want to have a little bit more specific of a conversation to your own needs, you can find my email, nashoba.bailey@securitiesamerica.com. You can find his email, hunter.bailey@securitiesamerica.com. And you can also find our phone number and website here. So if you want to give us a call at 916-863-1266, you'll get in touch with one of our admin staff, and you can schedule a call with us at any time if you want, or maybe they can answer some simple questions for you. You can also head to our website, hunterwilliambailey.com, and you can see some of our educational resources, and that's eventually where videos of this class will be uploaded. Sure.
Are all those numbers on this sheet?
Yeah, those numbers are on this sheet, so you'll be able to, the same phone numbers and website there. Okay.
I can reach you via email if we need.
Yes, absolutely. At any time, you can always give me an email. I'll be sure to respond quickly. So, moving on to the meat and bones of our class. Our class is titled Active Retirement Investing. Really what that means is taking an active role in your retirement investing. It doesn't necessarily mean active investing strategies or day trading or anything too fun like that. It's really just taking an active role in your investment, usually for retirement, sometimes for estate planning, or whatever other purposes you may have. But it's really getting in there and having a good understanding of what's going on, knowing how your solutions are affecting your plan and how they take you to your end goal, and knowing what that end goal is. You'd be surprised how many people don't actually know what they want their end point of their financial journey to look like, or how they want things to go when they reach the conclusion of their plan. So it's good to have that down. So moving forward, whether you do your own investing, or you want to check on your advisor that you already have, or you just need to find some answers and help, this class is for you, this book is for you, and I'd like to think we are for you as well. So we are always here, number one, as educators. We want people to understand what they're trying to do. We want people to understand what advice they're receiving, because a lot of times you will be in a situation where you just kind of blindly believe your professional, because they're supposed to be the experts, right? But you don't know for certain that what they're doing for you is the right thing. And sometimes it's not. As unfortunate as that can be, sometimes you're going to pay these big fees and still not get the advice that you deserve. So it's good to understand what is coming to you and how it does actually apply, even if you don't understand every little piece of the technical puzzle. So firstly, one of the things you'll want to look at is a couple different goals that you might be able to establish. There's a lot of different things that we can do with investments. There's a lot of different things that we can do with our finances. And it's very important to know what your goals are so that we can create the right plan to accomplish them. So a couple different things you might be looking at. Very commonly, you might be looking at maximizing your retirement income, knowing from which assets you're going to pull money from, knowing how you can bring that all together to give you a fun retirement with plenty of assets and plenty of cash flow to do the things that you want to do, rather than be held by a very small income replacement after retirement. Reducing your income taxes. You might be in a situation where you have plenty of assets, but you feel like you're losing so much to the government that maybe you want to move things around and create a little bit more efficient of an income stream. Inflation protection, which is really just a fancy word for getting invested, getting into equities and getting into assets that are going to grow in value alongside inflation so that you're not losing money every year sitting in a bank account. Funding your child's education is very common. That's obviously what 529 plans and things like that are for. You might have an education that you're looking to fund in the future, and it's important to kind of know what kind of risks do I need to take, or what kind of strategies do I need to implement in order to fund that in the future. Estate growth, there's a lot of people with plenty of money and they want to leave it to their beneficiaries, but they want to see it continue to grow so that those beneficiaries can get the max benefit out of those assets. Financing travel and entertainment, that's kind of similar to maximizing retirement income, because sometimes you want to actually do stuff with your money when you end up retiring. Not everybody wants to sit on a big fat pile of cash and then give it to their kids at the end of the day. Some of them want to spend some of it, or some of them want to spend all of it. And there's nothing wrong with that, because you worked for the money that you invested, and sometimes it's a good idea to actually enjoy a little bit of it. Distribution of assets. It's very critical to know that if you are distributing assets to other people, both during your lifetime and after your death, that they are going through the correct routes to those people so that you're actually getting an efficient transfer, or maybe things are not becoming public when you want them to stay private. That's a very important thing. Protecting accumulated assets. There's also something to be said about, of course, you want to invest for inflation protection, or maybe you want to invest to grow your estate, but it's also very important to protect that by taking the correct amount of risk for what you're willing to go through, as well as keep those assets protected from people like creditors and lawsuits and that sort of a thing. So there are different strategies that you can use to put yourself in between those creditors and those assets. So before we move on to how we sort of do things, we'll take a look at what a traditional plan might end up looking like. These are generally very long, big stacks of paper that you got, and you're flipping through it, and that's when you start getting that information overload and you don't really know what's going on. So you might get a letter to the client that's going to begin the engagement, and you'll have a copy of that. You'll get your table of contents that shows all the different sections that you're going to go through, all of these different individual core planning sections. You'll have all these different introductory materials like the mission statement of the advisor, their principles, core values, ethics statements, privacy statements, investment policy statements, tons of disclosures front to back. You'll have a client profile, which generally what that means is it's kind of taking a snapshot of you at this point in time and sort of figuring out, okay, what is it about this person? What are their characteristics? What are they looking for? What kind of risks are they willing to take? What kind of planning do they need? Executive summary or observations and recommendations, which will be one of the longer portions of the plan, which will be detailing out all the different recommendations that they've created for you in your situation. All of the individual core content planning sections, so all of the different things that they did individually to generate those recommendations, like cash flow analysis, net worth analysis, tax analysis, insurance risk management analysis. Just a lot of paperwork going over all the things that they reviewed for you. You have different types of insurance that they'll be covering. Investment analysis, obviously looking at your assets and how they're allocated. Retirement analysis, which generally that has to do with cash flow planning after retirement. So there's a lot of retirement planning software, and you might have heard of something called the Monte Carlo analysis or simulation, where we take what you have and input like 1,000, 2,000 different versions of the same scenario happening, and then average those numbers together and see what kind of probability you have of success in the future. You might have some special analysis for some different things that you have that are particular to your situation, which could be education funding, special needs, refinancing, saving for special objectives. You'll have the implementation and monitoring section, which takes all of those analyses and all of those recommendations and then gives you the instructions on what you're supposed to actually do to implement this plan. And then you might have an acceptance letter or an engagement letter that kind of says that the relationship is beginning. And then you'll have your appendices at the end with all of the different numbers that they had to use, all of the different disclosures for those things, for all the stuff they did earlier to wrap it all up. Now, personally, we think that's a very long process for a lot of clients that don't necessarily need that much in-depth paperwork to look at. Not everybody needs a 100-page stack of a financial plan just to figure out what they're going to do with the IRA. That's not always necessary. So we like to break it down and simplify it into something that's a little bit more fluid, it's a little bit easier to kind of take in and chew on and move forward with. So we took financial planning and we broke it down into 3 distinct phases. The first phase focuses on evaluating what you have and then planning goals and how we're going to get to that section in the future. It's really, that's where most of financial planning comes into play. That's when we're looking at cash flow analysis. That's when we're looking at retirement income analysis. That's when we're looking at all these different things that we're trying to accomplish and creating some sort of plan of how we're moving forward. Phase 2, which is where we work the most on, is where we are creating the portfolios and investing them accordingly so that we can actually get you to a point of having the assets to fund all of the things that we talked about in phase 1. So phase 2 is where it gets highly complicated and technical, and you have all these different risk metrics and how you're putting your portfolios together. That's the strain that we like to take off of our clients. So a lot of what happens in phase 2 is going to end up being something that the client needs to do themselves, like getting new insurance policies, making sure that they have a proper budget for their retirement, sorts of things like that. But phase 2 is where we like to take the workload and allocate the investments for the client so that they don't have to be worried about fluctuations up and down the market and deal with that themselves. In phase 3, that's where you basically are just looking back on everything that we did, and every period that you might want to review it, could be yearly, quarterly, whatever you want, is when you're looking back on all of the work that you did, on all of the investments that you did, the allocations, making sure that they still, every time you review it, fits into your plan, and if anything has changed, make sure you adjust for that change. It's very important to stay up on your own financial situation, because you might think you set this plan, you set it in motion, and we're done. But oftentimes, things happen in life. You might need a sudden inflow of cash. You might suddenly get a big inflow of cash, and you need to adjust your plan for what happens there. So more specifically, in phase 1, we talk about current and future cash flow, insurance coverages, how you're doing with taxes, do you have an estate plan, and looking at your existing investments and kind of getting an idea of where are we in that boat. That's when we look at your financial documents. That's when we look at net worth, cash flow, all those different things, and really just get an idea of where you are standing today and what we need to do to change by updating your financial strategy based on all of what we just looked at. So that's when we're really looking at all your information, getting an idea where are we at, snapshot in time today, where are we trying to get to, and how can we get there in the period of time that we have available. Phase 2, like I mentioned, creating portfolios, making sure that they align with your individual risk tolerance and what is suitable for you. And suitability can mean a lot of different things. That'll mean stuff like how much risk we're taking in the portfolio. That's a very easy one to wrap your head around. But it's also, is the client sophisticated enough to understand the benefit of a particular investment or to realize the entire benefit of an investment? And diversification is something we talk about a lot. We really like diversification. It's kind of our key word. It's how we spread ourselves across enough investments to not suffer too much from any one particular investment failing. And in phase 3, like I mentioned, that's when we're looking back and monitoring everything, looking at the portfolio on a constant basis to make sure it's still within our guided parameters, making sure that we look at all the different goals that you might have and if they change. So that's basically our 3-phase process of how we simplify financial planning and make it a little bit easier to get into. So in phase 1, this is kind of like our medical checkup. It's when we look at your situation and we get an idea, how are we doing, how healthy are we, and what are the areas that we need to touch on to get fixed. So we call these the diagnostics, because really we're looking at the whole system of your financial plan and we're evaluating each piece as its own and seeing how you're doing with each of those. So cash flow is important because if you're spending more money than you're making, obviously there's a problem there and you're going to be in net decline on your financial journey. So that's something to keep in mind. Insurance is important because we like to say that insurance is the worst investment you'll ever make because you always have it but you never use it. But the idea with insurance is you're insuring against very low frequency but very high impact events. So you want to have the proper planning for insurance so that if something happens that you don't expect, if something in life really brings you down and you need a lot of assets, that they don't come out of your investments and change your plan and make you not able to succeed in the future. So that's really what insurance is doing, is it's protecting our plan from continuing to work. Because if we have a sudden need for $100,000, but that takes us off our guide to go to our destination, then that kind of ruins our investment plan. So that's why we want to have proper insurances, proper liability, proper umbrella policies just to cover in case things happen. Estate planning, we like how are your assets moving, especially after death? How are they moving from one person to another? And is it going into the right place? Does it have the right rules attached to it? Is everything transferring efficiently? Is it private? Is it public? All those different things. Taxes, we like to make sure that you're not spending too much in taxes. Though there's not a lot that you can do to really get around the fact of paying taxes, there are some things you can do to shift, to bring some of your overall liability down, or at least to make it a little bit more efficient going into the future and take advantage of a couple things available to you. Because some people just don't know what's available, and that's very unfortunate when you have things that you can do to bring your tax liability down, but you just don't know about them, so you don't do them. And then obviously your portfolio and your investments, very common thing when you're looking at the different risk parameters, how diversified you are you actually on the right track if we look at historical performance to get you to your goals. Phase 2 is where we come up with our new portfolio construction process, and all of these things that we're talking about we'll go much deeper into later. But just to give an intro, we use two different distinct processes when we're creating a portfolio, and this is what most people are most interested in. We use lateral integration, which is basically using the factors of time and your risk tolerance to get an idea of how we can be allocated today versus a couple years from now versus the end goal. And then we use vertical integration, which is pretty much diversifying across different assets so that we have our risk spread out and so that we're not taking too much individual risk in any one particular area. Because one of the things is if you have all of your portfolio in one individual stock and that company doesn't do so well, you're not going to do so well. But if you're diversified across many companies, diversified across many different assets, many of those securities, many of those companies can fail and it still won't drag you down if you have proper diversification. Phase 3, again, like I mentioned, that's when we do our monitoring, that's when we do our look back on what we've done. So with regards to investments, it's making sure that the risk levels have stayed in line with what we're looking for. Because often, as time passes, we look to be less risky. Because as we get closer to the time period where we need the assets, we want less of a chance of those assets going away. So we want them to stay protected. So that's something to look at is as you get closer to your end goal, are your risk levels dropping to a satisfactory level? Are your allocations staying proper? Because as different sectors can grow, as different positions in your account can grow, it can throw off your allocations by a bit. And now suddenly you're taking on way more risk than you expected to, but you haven't done anything. So you thought, well, I didn't make any changes, so why is this suddenly completely out of whack? It's because you weren't paying attention to what the allocations were doing. Distributions, making sure that you are actually properly funded to take money out of your account from things that aren't going to suddenly crash in value the day before you need to take the distribution. So planning for those and making sure that we have them continuously funded and that you can fund them through your lifetime is very important. Estate planning, going back over your designations for your beneficiaries on whether it's trusts or insurance, life insurance, investment accounts, bank accounts, your house, doesn't matter. You always want to make sure that you're still on good terms with the person you put on that policy. You want to make sure that you actually want them to receive those assets. So you'd be surprised how many times people forget who's on what. So it's good to keep a good list of what all of those things are. Reviewing your trust documents. Oftentimes you're not going to make a lot of changes to your trust, but it's good to know that you don't need to make any. It's better to always be a little ahead of the game and make sure that everything is in line every year rather than find out that something is not quite what you want it to be a few years later. Keeping up with the times. This is one of the things that people probably want to do the least, is staying up on what's going on in the world and staying up on all the different regulations and laws and tax codes and all different kinds of things that change. It seems like almost every day. All the time we're seeing new, Secure Act 2.0 came out a while ago and that made a lot of changes. When Trump was in office, the Tax Cut and Jobs Act, I think that's what it was called, that also made a lot of changes that helped with some things and hurt other things. So it's very important to stay up on all of this information so that you can know if it's going to affect your plan. Because oftentimes it may suddenly make a certain thing that you're doing not so viable. Like what if one day Roth conversions suddenly stop being effective? That would be something that you'd want to know so that you don't go to make that move one more time. So it's important to know what kind of investor you are. Are you a DIY investor? Are you a person who wants to do it themselves? There's absolutely nothing wrong with that. But the main thing you got to keep in mind is you want to be as qualified, if not more qualified, than the person that you were going to hire. Because what would be the point in doing this if you are doing yourself a disservice by not knowing what you're supposed to know? So don't be afraid to delegate particular sections you're not an expert in. It's okay if you are just the best investment manager in the world and that's what you do best, but you want to give the estate planning to somebody else. You want to give the tax planning to somebody else. Or maybe you've been an accountant your entire life and that's what you do best. So maybe then you want to hire an investment professional, hire not a tax preparer, but an estate planning attorney, those sorts of things. So it's okay, even if you want to do it yourself, to pick things that you know you are not an expert on and delegate those to other professionals as well. If you're using an advisor, obviously check their background with something like FINRA broker check and be able to evaluate the advice given on a basic level. You want to make sure that you know what's being told to you is the proper thing for you to do. Because, I mean, like Bill mentioned, the commissions we're not a super big fan of because there's an incentive there to sell you the product that pays the higher commissions, regardless of whether or not it is actually the best solution for you. So knowing that what's being recommended to you is the proper solution is very important. And if you're seeking answers, have a well-tuned BS meter. Be able to spot it when you see it, because there's a lot of people who they'll hear something that sounds like the perfect fix for everything they've been looking for. And you find out after a couple years of participating that it wasn't at all what you thought it was. It wasn't what it was sold to you as. Maybe it just wasn't real at all. We have a couple stories, both in the office and out, of people who have put their life savings into investments that they thought were going to be the thing that brought them all of this great money and just gone, never to be seen again. I mean, I have an old friend who got all of his family and some of his extended family to take all of their life savings and put it with this lady who said that she was going to trade options for them and pay them, get this, 10% a month in perpetuity. Sounds like a pretty good deal to me, right? I put $100,000 in and I get $10,000 every month in cash out. And that worked for a while when new people brought money in and she could take that money and pay it out to the old people. But what happened when she didn't have such a good month or such a good quarter and people stopped coming in? I'm not able to make payouts right now. And now she's been sued by the SEC and all of her assets have been taken and seized and are being distributed back out to hopefully make some of those people whole again. But what happens when that person spends all the money? Then you're not getting anything back. So do you really want to take that risk? I don't think so. So it's really important to know when you're being told something that is way too good to be true, because you will be a few years in and you'll realize that you made a really big mistake. So don't make that mistake. So before we really get into any topics in our next class, one of the things I want to go over is a couple broad concept definitions. I just want to make sure we're on the same page about a couple things that we're going to talk about. So first of all, we're thinking about investing. Investing is not putting your money in something and knowing it's going to double by the end of the year. Investing is the process of taking calculated risks in the open market that have a probable positive outcome over a measured period of time. In plain English, it's investing in things that you know have historically done relatively well in comparison to other investments, don't have a huge degree of risk associated with that performance, and over average, long-term, lots of data give you a positive expected return. The S&P gives you a positive expected return, but there are plenty of years where it's down 20%. But you got to be able to look at the bigger picture, at the 10-year, the 15, the 20-year, 30, 40, 50, whatever it is. You got to be able to look at those bigger time frames and look at how the data supports, even after those horrible years, when you average all of that out, how it gives you that positive expectancy. Risk. Risk is the possibility of negative outcomes. It's really as simple as that. If I invest in the S&P, it's the risk that we do see that negative 20% year. Now, return is directly related to risk. Pretty much in every scenario. Most things have a pretty straight correlation between the amount of risk you're taking and the amount of return that you could make. So if you want to make more money, you need to take more risk. Yes?
When you're talking about investing,
Yes.
are you talking stock market related things?
Yeah. So for the most part, we're talking about the stock market,
You're
mutual
not talking
funds.
real estate or...
No, though some of these concepts can be applied in that way. When we're talking about it, we're mostly talking about stocks, mutual funds, and that sort of thing. So that's just the lens that we're looking through. Yeah, yeah. And financial planning, as defined by the CFP board, which is one of the great organizations. If you've got a CFP financial planner, that's really good certification for them to have. Working on that one. Financial planning is a collaborative process that helps maximize a client's potential for meeting life goals through financial advice that integrates relevant elements of a client's personal and financial circumstances. So really that's just saying the process of financial planning is looking at those information that we talked about earlier, phase one, looking at that and creating a plan and using financial advice that we'll define in a moment to help you along that plan. So, a financial advisor is a licensed professional giving specific recommendations to a client, generally based on that client's financial situation. So, this phrase here, specific recommendations, that's generally what you'll think of when you think of financial advice, is when I have your information and I'm telling you to do a very specific thing. If I'm telling you to buy a mutual fund, or I'm telling you to create a certain type of trust, or I'm telling you to buy a certain insurance policy, that's kind of what you can think of as financial advice. So a couple things that might fall into that, like I just mentioned, stock and fund picks, type of investment accounts, that's something that constitutes as financial advice. That's a recommendation. If I'm telling you to use a regular IRA versus a Roth IRA, those have different results at the end of the day. They have different things going on. So there has to be a specific reason why I would recommend that type of account. Insurance products as well. Generally, when we think of financial advice and insurance products, we're thinking about stuff like variable annuities or whole life where there's an investment portion. But we're also recommending term policies at times and things like that. Long-term care is another one. And there's a lot of other specific things that we could get into that would constitute advice from an advisor. Now, fees. Fees are something that everybody hates. But at the end of the day, a lot of times, unless we're going to do the work ourselves, we've got to pay them. So fees are dollars exchanged for either some product or value not otherwise received, or for convenience and reduction of workload. A really simple way to look at this is if you go with a financial advisor, you're reducing your workload by not doing all the work of researching all of these different things you need to do, by not learning how to create a portfolio and what kind of account to pick and exactly how much risk you need to be taking and all of these different things. You're using the convenience of the advisor. That's why you're paying the fee. You're not paying the fee because they can do it so much better than you ever can. You're paying the fee because you don't want to do it at all. So that's one of the reasons why we pay these fees. And another example is on a mutual fund, is if I want to have exposure to the tech field, but I don't know how to pick tech stocks, I don't really know what I'm doing, I might pick a tech mutual fund that knows what their strategy is and they have good performance. But I'm going to have to give up a little bit of the money they make in order to get that convenience and reduction of workload. So that's what you're paying in expense ratio. So now we'll take a look at our schedule. So that's this that you were handed out earlier. It's got our 12 weeks of classes, and we'll just kind of go over the different things that we're going to be learning as we go. There you go. Yeah, no problem. So obviously today, we're just kind of introducing everything that we're talking about, the different goals you might have, different phases of our process. Next week, we'll start diving into phase one and the different things that we'll do, the diagnostics, kind of how to evaluate your situation. After that, we'll start talking about account types, market indices that we look at, types of funds, how to evaluate portfolios, and all that kind of stuff in a very overall broad sense. After that, we'll get into phase 2, where we start talking about the new portfolio construction and all of the different ideas and concepts and strategies that we use when building it, and sort of give you that underlying understanding for all the stuff that we're going to do in the future. After that, we'll talk about the ways that we construct portfolios and the different types of investors that those apply to. So once we get that understanding beforehand of how we're gathering all this data and how we're putting it together, here is where we'll show you how to actually use that data practically and create a portfolio for yourself. And we'll actually create a sample portfolio along with the class so you can see how that process works and sort of where we end up at the end of the day. After that, we'll talk a little bit more about the implementation of lateral and vertical integration and the different ways that we can get through all those scenarios. And modern portfolio theory will be another thing that we talk about. It's a very complicated subject. That's where we start talking about the different ways to calculate risk, risk-adjusted return, the standard deviation, and all these different ways that we evaluate investments, especially over different periods of time, so that we know how to pick them. Modern portfolio theory is really the basis for a lot of recommendations that we give, just because that's the understanding that a lot of the industry has settled on, and it's what we use as our jumping off point. After that, we'll start talking about investment objectives, risk tolerance, some more example portfolios based on a couple different investor avatars. So we'll look at a couple different types of people that you might run into and what kind of portfolios you might want to use for them in very simplified terms, so that you can see how it lines up both with their objectives and their risk tolerance and all sorts of different things. After that, we'll finally dive into class 3, phase 3, which we'll start to talk about after we've implemented the portfolio, after we've implemented all this financial planning. How are we monitoring that? How are we making sure that everything stays within our guide rails for our plan? How are we getting proper tax efficiency? Is that a priority? And how do we address that? All of the different things, daily, weekly, monthly, quarterly, biannually, and annually, all the stuff you want to be looking at all the time for your investment portfolios to make sure they stay on track. After that, we'll talk about estate planning maintenance. So that'll be just a really simple review of different trust types, different account types, a little checklist that you might want to go through to make sure that all of your assets are titled in the proper forms. We'll go into tax efficiency management, which is really just a couple different opportunities here and there that you may have, different ways that you can title property that could help your situation more than you know. And we'll talk about real estate in a little bit. And then finally, for class 12, we'll do a review of all the stuff that we've learned. We'll talk about DIY investing, hiring an advisor, what types of fees you might pay, and how that relationship might go, and also how you might check in with an advisor that you currently have. So that wraps up everything that we'll be talking about in the future, and hopefully that gives you a pretty decent idea of what we're going to be doing as each class goes on. And that brings us to the end of today. We've got 5 minutes at the end of our class, but we like to stick around until like 2:30 so that we can answer some questions. But if there's anything you guys want to ask about what we're going to do moving forward, now would be the time. But other than that, that's it for today, and I hope you stick around.
Can you
Yes?
let us know a little bit between the investments, like the mutual fund versus exchange traded fund? Or
We
you
will
guys are
we will
familiar
talk we will
with,
talk
yeah,
about that.
those vehicles?
Yeah, but we'll get there. Okay.
Any questions? Any topics you guys want to talk about? Yes.
I can think about a question since this is my first participation
Absolutely,
in class.
sure.
Thank you. But, so you're presenting a lot of slides with a lot of information.
Yes.
And you're kind enough to give us a book. And so I'm trying to figure out what's the best way to capture the information. I don't know if what's there is actually in the book, or some people are taking pictures. Could you make a suggestion or comment about that?
Sure. So a lot of the information that you'll see in these slides will be in the book. So if you'd like to review them later, you can. But I would recommend today was very much a going over all of the stuff that we'll talk about in the future. So we'll dig deeper into the details later. So all of the things that we talked about today, we'll dive into deeper. And I would highly recommend taking some notes as we go along. And if there's anything that you don't quite understand as of the first run, feel free to ask questions. But again, I would take notes on slides on all the information that you see, and maybe pick up the book afterwards to sort of see if you can find them in there and dive deeper into the details. But also anything, obviously, if you don't understand anything, feel free to ask questions, send emails, that sort of thing.